All right, everybody. Hope you're doing great. We will start here in just 1 minute. Got one more thing rolling in. We will start in just about 1 more minute. Give me 1 more second. Sorry about that. All right, everybody. Hope you guys are all having an amazing night. Glad to see you're all here with us. Welcome to our session on futures trading. Let me turn on the share screen so that we are ready to roll. First of all, welcome. Glad you're all able to join us this evening. Let me make sure that I turn on the recording so that we have this set up. All right. So, for those of you that are new and that I've not had the pleasure to meet before, thank you so much for being able to join us this evening. For those of you that are regular subscribers and regular members, thank you so much for taking the time to come in and see. We're going to talk about some of the foundations and fundamentals of futures this evening. So that's really the purpose of tonight is the foundations and fundamentals of futures and some of the things that we are looking into. So, really quickly, if I can, I would love to do to get a little bit of a feeling, if you will, for how many of you out there are currently actively trading futures. Type it in the chat box. Let me know if you're actively trading futures and what you're doing with futures. Those of you that are actively trading it, let me know kind of what you're doing with futures. Okay, John is the indices, Caller and Arlene, John Sr., Muriel Patel. Okay, so a number of you are. How many of you are completely brand new? Anybody in here completely brand new on trading futures? Okay, so Maka's brand new. All right, everybody. Hope you guys are all happy. All right, Maka's brand new. All right, excellent. So I just wanted to find out, just kind of get a little bit of a gauge of the room and see who was doing what and what you may or may not be using. So as we go through this, I'm going to start with some of the foundational basic levels, why people trade futures, what they are, and then we're going to dive into really looking at some setups, right? Because I think it's important just to get the basics and the foundations of what they are. Now, as we go through, I want to just really, I kind of call this beat the tweets, right? It's about getting ahead of market movements that happen in the overnight sessions. How can I help to get ahead on those so I can get ahead of those overnight sessions? Tom's in the Sim account, mostly losing. We'll see what we can do about that. George, is everybody else hearing me okay? Just want to make sure everybody else can hear me all right. Okay. So, Mike, maybe you can type something to Georgia if that's okay by you. That would be amazing. So, all right. So let's go ahead and get into some of the foundational things. So, what is a futures contract, right? Futures contracts have really been around forever. And think about what a futures contract is really designed to do, okay? Let's talk about what a futures contract is designed to do from the very beginning, because futures are really used for two distinct purposes, either as a hedge or as speculation. So, we want to talk about both of those because both of those are really super important to what futures are and why we use them and how they work. So when I'm thinking about futures as a hedge and I'm drinking a cup of coffee. Now, why is it that coffee prices go up and down, up and down, up and down, up and down, but the end product, which is the coffee that I buy from Keurig.com, that is not an endorsement or a recommendation. Why is it that the coffee that I buy at Keurig.com is relatively stable in price, right? Why does that happen, and how is that? If coffee prices go up and down, right? Same thing with oil prices. Oil prices go up and down, but we don't see instantaneous fluctuations in the end use, right? So let's talk about what those are and what they're for, right? If you think about in any market, we have two distinct groups in any market. What are our two distinct groups that exist in any market force? Two distinct groups. What are they? Yeah, they're my buyers and my sellers. So if I know that in any market I have two distinct groups, they're buyers and they're sellers, I'm going to try to think about this in the simplest way possible. So in the simplest way possible, if I have those two distinct groups, those buyers and those sellers, I have in the world of futures, I've got producers and I have consumers, right? So think about producers as your farmers. These are your farmers that are growing the crops. So your farmers that are growing the crops, if you think about what happens, the farmers that are growing the crops, the crops don't happen all year, right? They happen at one time. So the farmer, when they plant their crops, they don't know if it's going to be a lean year or if it's going to be a banner year. Now, if it's a banner year, what happens to prices? If it's a banner year and there's all kind of crops, what happens to prices? In that case, prices go down, right? And when prices go down, the farmer gets very upset. He gets very sad. But the end consumer, and when I say the end consumer, I'm not talking about you or me. What I'm talking about specifically, when I'm talking about the end consumer, is that I'm speaking about the Folgers, right? Or I'm talking about Green Mountain Coffee Roasters or Starbucks, right? So the end consumer is the big company that's kind of like think of them like the manufacturing plant, right? They're the coffee roasters, the manufacturers. So the coffee roasters and the manufacturers, they want coffee prices to go down. So if it's a banner crop and coffee prices go down, they're feeling really good about things, right? So here's the way the futures contracts are really designed to work. What they're designed to do is that the futures contract is a forward-looking contract, right? It's a forward-looking contract. So what the farmer will do is the farmer might expect all of this corn or coffee or whatever it is to grow, and the farmer might write a futures contract on this portion of it, right? So the farmer writes a futures contract just on this portion of it, not on all of it, just on a portion. Now, that contract, let's say that that contract, the farmer is the producer, he or she becomes the seller of that contract, right? So they sell that contract. Now, when they sell that contract, they're obligated to provide this coffee. They're obligated to provide this product. To whom? Well, they're obligated to provide it to the buyer. And the buyer of that contract is obligated to purchase it. Now, let's say that it's a lean year. It's a very, very lean year, right? Well, if it's a lean year, the seller is still going to sell what they had already agreed to. But if it's a lean year, what are the prices going to do? The prices are going to rise. Well, the seller is this amount of money here on the contract, even though it's a lean year, he or she's still going to be able to sell this contract for the agreed upon amount, and they'll be able to sell what's left, even though it was a smaller amount, at a slightly higher price. Now, in this case, the seller has given up that upside potential in order to lock in that price, right? To lock in that price. Now, the buyer of the contract, they bought it at a low price, right? So they're actually really, really happy because they locked in those lower prices. Now, what if it's a banner crop, right? What do they call that? A bumper crop? And if it's a bumper crop and we have way more than anticipated, well, the prices now are going to go down. Prices are going to go down. So the
Why did I
prices are
take
going to
it?
go down on the money on the remainder of the crop that's sold, but the loss is made up by what was locked in at a higher price. The whole idea with hedging of futures, very simply, is to stabilize prices. That's it. It's to stabilize and lock in prices. So futures are primarily done as a way to stabilize and lock in prices over a given period of time. That's what they're created to do, and that's what most people primarily use them for in the world of hedging. Now, when we think about futures, a future, it's a standardized forward contract, meaning it's quite literally a legal agreement which obligates somebody to buy or sell something at a predetermined price on a predetermined date. Now, this is very different than options. What's the difference in options versus futures? Can somebody tell me that one of the main differences in options versus futures? Well, Eric, the expiration, they both expire. But just in this beginning part, we're just talking about the obligation versus a right. Okay? So think about it. If I'm doing calls or if I'm buying a call, I have the right to buy a set stock at a set price on before a set date, right? But not the obligation. If I do a futures contract and I buy it, I'm obligated to fulfill that side of the contract. And so this is where you hear people getting in trouble with futures, is because they don't understand that obligation, right? They don't understand the fact that they've got the obligation when they're buying a contract. And so I heard a story one time of a friend of mine who he had gold bars show up at his house because he had I'm not gold bars, I'm sorry, silver bars. Now he had the money in his account in order to fulfill the obligation, but he let the contract expire, right? Now, the idea there is that when you are buying options, you've got different obligations. You've got rights, whereas in futures, it's all obligations. Okay. Now, commodity futures as a hedge makes sense, right? Everybody understands the hedge of commodity futures. Why would somebody use equity futures, right? Because there are futures on things like the S&P 500. There's futures on things like the NASDAQ. There's futures on the Nikkei. There's futures on the Russell. There's futures on all these different markets. What are they hedging? Well, think about it. If you are, let's say that you're TD Ameritrade, right? And as TD Ameritrade, let's say that you're TD Ameritrade and you've got 50 million, you've got tons and tons and tons of stock, right? You've got all this stock that you hold in inventory. So you got all this stock that you hold in inventory, all this inventory of stock, right? I'll just actually, I don't know how to represent it, but you've got this big old pile of stock that you have in inventory. And if the market goes down, this stock that you have in inventory, you use this, right? So this might be all the different ones that you have, and you loan it out for shorts, and you use it as investments, and you keep some on the books because you're carrying other people's stock, and they've got all this stock. It's all out in people's accounts, and it's working, right? It's not just sitting on a shelf. It's out being loaned out, generating margin interest, doing all this. But when it all boils down to it, this stock is sitting on the shelves of TD Ameritrade. Well, what happens to the value of this stock if the market goes down? Think about it. What happens to the value of this stock if the market goes down? Yeah, it's going to be worth less. So the company, what they may do is, let's say that they've got, I don't know, I'm just picking a number, $50 million worth of stock in inventory. Well, what they may do is they may sell S&P or NASDAQ or Dow futures contracts. Now, if they sell those futures contracts, now how much are they going to sell? Enough to hedge this, right? So think about it. If this goes down 2%, if their portfolio goes down 2%, but they've shorted on this side, what's it going to do on this side? It's going to go up 2%, right? This is a perfectly balanced hedge. This is a perfectly balanced hedge. Now, why would they do that? Well, because they're not making their money on the up and down of stock. How are they making their money? Commissions, margin interest, spreads, all those other things. The stock is simply the vehicle that they use. The money is made from the transactions of the items that are on their shelves, trading against their clients, right? The money is made from the transactions that are going on in there. And so when we think about equity futures, that's what equity futures do, is that equity futures are used as hedges institutions can use against stock that they own. Okay? Now, how can we use futures as a hedge in our lives? So how do we use futures as a hedge in our lives? The way to use futures as a hedge in your lives are those of you that are, I'll just call it, stuck in the 401k land, right? So you can theoretically take a look at your portfolio and use it as a way to protect yourself in a down market if you're stuck in a long position, right? Now, we talk about using options as insurance, but options have a decaying component, right? They lose value over time due to time decay. Futures do not. A future has no time decay element. So it's, whereas an option will expire where it's going sideways, and then it'll fall off and it'll drop off slowly at first, and then it'll drop off. A futures contract, the time value remains constant until it expires. There is no time decay necessarily to worry about. So you might want to use futures as a hedge in your big bucket, in your wealth bucket, in a portfolio. For most retail investors, doesn't make sense, right? It's not the right vehicle for most retail investors. For some, maybe. For most, probably not. We want to use futures as a speculation vehicle. And when I talk about a speculation vehicle, we're using futures to profit from the speculative effect. Now, a futures contract, because it's created as a hedge, makes a good speculation vehicle. That's why I spent so much time on the hedge, because you got to remember that the hedge allows the futures contract to control an item without necessarily having to own it, right? I can control it without necessarily having to own it. So why would I want to use futures in the first place, right? What are some of the advantages of futures? So the first one is low margin requirements in most markets. And when I talk about low margin requirements, we're going to talk about how much capital is tied up in my account versus what's controlled, right? So let me give you an example. And I'm going to pull up a chart. Let me move a chart over here. We're going to look at a chart of crude oil, okay? By the way, did anybody catch that crude oil breakdown today? Anybody catch our crude oil breakdown today from the daily market commentary and from the trade rooms? Nice, Johnny. Love it. So the current price of crude oil is $55. Is $55. Nice, easy, round number. So we're looking at the September futures contract. How do I know it's a September? Because it says so right there. Some platforms, you'll actually have the full name, CLU19, right? That would be, /CL. This particular platform, I have to put the slash in front, right? And now the U is going to be different than, say, the Z. And the Z is the December contract. The U is the September. Now, we'll talk about why they're different and what that means in a little bit. But the key here is to talk about leverage. Now, the thing about futures is that each future has a contract. What's great about learning a little bit more about these contracts is it's a great idea to go to the CME's website. And I think the CME group, CMEgroup.com, it's an excellent place to go and learn a little bit more about what you're trading, right? Go learn about what it is you're trading. So when I go into trading on the CME's website, and none of this is, this is pretty simple stuff to find that everybody can find. But if I go to trading and I go to the energy product groups, here are the energy product groups. I'm going to click on crude oil futures, ticker symbol CL. Now, when you look at this, all this here at the top, quotes, settlements, volume, time and sales, it goes right to contract specs. So it tells me that it controls 1,000 barrels of oil. And its price quotation is US dollars and cents per barrel. So it tells me the trading hours, right? 60-minute trading break each day at 5 p.m. And then it trades Sunday from 6 p.m. to 5 p.m. Central Time. That's Eastern Time, 5 to 4 Central. Now, here's what I care about. Minimum price fluctuation is 0.01. So the minimum price fluctuation is also called a tick. T-I-C-K, a tick. So the tick is the minimum price fluctuation that you can have on a contract. Now, in this case, the tick is worth $10. So it's $10 of value per tick for every contract. So what that means, if I do the math very simply, it is $10 per tick. Well, that's because it's 1,000 barrels of oil that it controls. Going back to the price of oil, if we're trading at $55, let me just go back to the /CL. If we're trading at $55, what's 55 times 1,000? It's 55,000, right? We don't need a whole lot of math, right? So if I do if I do this, it's $55,000 that I'm controlling. If it moves from 55 to 56, it's moved up 1,000. It's moved up essentially 1,000 ticks, right? 100 ticks. I'm sorry, 100 ticks. So 55 to 56 would be 100 ticks, right? Well, it's 100 ticks times $10 per tick. So when I buy and sell crude oil, I'm controlling $55,000 worth of oil. Now, here's where it gets interesting. How much money do I need in my account? Okay. Actually, John, I will. That's a great question. We'll get to that in a moment. So how much money do I need in my account? Well, I can look at what are called the margins. So right here are the margins. Now, the margins on the contracts, we're going to look at what's called the maintenance margin, right? This is what the exchange requires me to put up in order to control that. So look at this. I'm controlling $55,000 worth of oil for $3,650. That's pretty good. Now, can I lose more than $3,650? Yes. Okay. Understand this about futures. If you do not understand how margin works, it can become very, very dangerous. You got to understand how margin works. So this 3650 that is the maintenance margin, if I get down to a certain percentage of that, they're going to call me out of that trade because they don't want me to stay in that position. But theoretically, you could lose more than you put into that position. Realistically, like I said, they're going to call you out of that position ahead of time. You're going to get some sort of a margin call. But yes, Marie, this is per contract. Very good. This is per contract. Now, this is the maintenance margin. The maintenance margin is set by the exchange. But when you place a trade, do you place a trade with the exchange? No, you place a trade with your broker. And some brokers actually have different margins for intraday time periods. So I've got a couple of different brokers on here. One of the benefits is that some of them have different margin requirements. Now, I'm going to pull up, by the way, I'm not making a broker recommendation tonight at all. I'm just showing you a couple of different ones. I frankly tried to find the margins page on TD Ameritrade and Interactive Brokers, and just they're hidden. They're hard to find. But I found a couple of them. So Here's one, Trade Pro Futures. And they've got initial versus day trade margin. And so, for example, this is the stocks. Here's the currencies. I'm going to go find the energies. Here we go. Crude oil. Now, they haven't updated this one, but their day trade margin, this particular broker, their day trade margin in crude oil is $1,000. Right? So this will tell you the margin amount on crude oil and what's required to do it. Now, yeah, John, that's a great point. Is it, let's see, where I've actually seen it, John, is here underneath futures trader. So if you go to the futures trader here, so for example, CL, it will tell me the tick and the margin requirement. So 43.80. Okay. So it'll give you the margin requirement, and as you adjust, it tells you the value per tick. Now, some brokers have that much lower intraday margin, and that number will change. For example, here is Infinity Futures, and they're very similar in margin price. They're also $1,000 for intraday margin. But notice they don't show the maintenance margin; they just show the day trade, and it's frankly harder to find on some of them. But the benefit is that I'm controlling, especially for a day trade, I can control $55,000 worth of oil for $1,000. There's your leverage, right? That's the leverage that it provides. Now there's different types there, and now overnight that leverage goes up. Okay, that leverage is going to go up. John, does TD take the opposite position as their retail customers? No, I'm not sure that I don't think they do, John. I'm about 99% sure that they do not take the other side, especially in futures. In options, I can't say one way or the other because you never really quite know what they're doing on that, but in futures they're not. So oh, and you guys are telling me to click. So in the futures tab, the down arrow, which you'll have to show me another time, John. Beside the symbol. Oh, futures. Oh, okay, right here. Yes. So this is where it shows it. Thank you. Thanks for that. So in the tab, here's your initial margin on each of these different positions. Hey, look, Bitcoin's only $33,000 of margin. That's not so bad. So, but yeah, this shows the margins for each of the products. So yeah, the maintenance margin is what's required to maintain the position overnight, and that's controlled by the exchange. Some brokers will charge more. Now, why would they charge more? Because they're more risk averse. The more risk averse that they are, the more that they're gonna control. Okay. So, Tom, so do you need to put both the margin maintenance and the intraday put up both the maintenance margin and the intraday margin per contract? No, Tom, you don't. It depends on what time of the day you're trading. So what you'll notice is if you're trading in an overnight session, your buying power will be lower than during the day for trading futures, like when you get into a position. So if I get into a crude oil trade right now, the buying power is going to hurt my buying power more than if I get into it at 9:30 in the morning because it's not tying up as much when the market's open. Okay? Now, along with this low margin requirements, I also have very inexpensive commissions. So from a commission standpoint, looking at, there's lots of different brokers, like I said, that you can look at. For example, TD Ameritrade, Interactive Brokers is 85 cents a commission, right? E-Trade's $1.50. TD Ameritrade's $2.25. Schwab's $1.50. I think TP Futures is not bad. So my point is none of them are crazy ridiculous. Interactive Brokers is about the least expensive one out there. But now this is the commission for the broker plus exchange fees. You do have to pay exchange fees as well on top of that. So, which is about another $1.20 on the CME items. So, but essentially think about it. I'm controlling, once again, let's go back to it. I can control $55,000 worth of oil intraday for $1,000 plus about $2 in commission. That's a pretty good, I mean, trading futures, by the way, used to be multiple hundreds of dollars to make futures trades, right? In and out was multiple hundreds of dollars. And so it's important to know that if you're going to trade futures, it's never been easier to get in and do it because of the availability in the markets. All right. Now, another huge advantage is the time that you can trade it. 24 hours trading, about 24 hours on most markets, right? Like we showed you, crude oil closes for an hour. So most markets have 24-hour trading. Now, why is that important? A couple of things. First of all, much lower gap risk. Your gap risk is significantly lower when you've got these markets. Do I still have gap risk during the week? Yes, I do still have gap risk during the week for that brief time that it's closed. Rarely do you ever see a gap during that period. And if you do, very, very, very small. Over the weekend, however, I do face gap risk. So futures open typically Sunday evenings at 6 p.m. Eastern time, U.S. Sunday, 6 p.m. Eastern, U.S. So adjust for wherever your time zone is. And they stay open until Friday at 4 p.m. Eastern. Sunday, 6 p.m. to Friday, 4 p.m. Now, some of them close for an hour throughout the day, and they have different times. When the regular market is open, that's called the cash session. When the regular market is closed, that's called the Globex session, right? So Globex sessions have different volumes than cash sessions, but the markets are still open. Now, why is that good? That means that if something happens overnight, like a tweet or an announcement or a tariff, God forbid those happen while the market's open, right? You have the ability to get in and out of your positions. That is valuable. Maka, great question. Is the Asia session actively traded? Unlike Forex, the Asia session is still the lowest traded session. So typically between 5 p.m. and about midnight is the lowest, smallest lull time to trade, right? So the lowest time of the day to trade is that Asia session, but your stop losses will still work, right? I mean, right now is the absolute lowest time of the day to trade. And if I look at crude oil, a way you can tell is by looking at the bid and the offer. Right now, I have a 1-tick spread. My spread is exactly the same now, right? 54.94 by 54.95. My spread is 1 tick wide on crude oil. If I move to something like ES, my spread is 1 tick wide. Even something like the RUT, my spread is 2 ticks wide. Oh, now it's back to 1. So my spreads might get a little bit wider during this slow time of the evening, but they don't get so wide that it precludes me from closing. So I've got stop orders that work pretty much any time. And now this gets really valuable when we have market announcements that occur in the overnight sessions. So for those of you that are regulars with us, what is the time of day that I tend to look for really good reversals? You know, when I'm really looking for great reversals? Yeah, right at 2 a.m. For some reason, 2 a.m. is an amazing time to look for high quality levels. And I will oftentimes look for high quality levels. Now, look at what happened in crude oil tonight. So we talked about, this was our breakout level that we looked at this morning in crude, was breaking down below here. Well, the real pivot occurred right around midnight. And then this level here that we wrapped our lines around, if we get a retracement, is right there at around 2 a.m. So I'm in Central Time Zone. So we get a really nice number of movements at that time of the day. So when we're in the live trade rooms and Sunday night sessions, we're looking actively at those time of day. Now, this is another example of crude oil really broke out, really started to make its move at a little after 4 o'clock this morning. I'm sorry, that's the RUT. Let me go to crude. Crude oil, which had the breakout. There it is. Crude oil had the breakout a little after 4 o'clock this morning. So I did the daily market commentary today at about 4:30 a.m. I think it was. And I was very much aware of the fact, hey, listen, we're setting up for a breakdown. Now, if you only trade one session, you only trade the cash session, you only trade equities, you miss out on those kind of opportunities. And then you wind up trying to play catch up. Okay. So that's one of the main reasons why we look at that market. It allows me to react to news, tweets, and announcements. As much as I am in no way political when I say this, I realized I was on the wrong market there. Thank you for giving me the heads up. I'm in no way being political when I say this, but President Trump moves the markets. There's no question about it. And part of me believes that he measures his economic success based on market performance. And so a day like today, I'm sure we're going to have some sort of, we had a big run up yesterday because we blinked in the China tariff war. And today the bond market reacted, came and showed us recession fears. And so the market sold off 800 points today. All of that happened in after hours trading. All of that was set up before the market ever opened in the US. And so that's why 24-hour markets gets available. Now, multiple asset exposure, global equities, bonds, currencies, and commodities. People ask me this a lot. Chuck, do you trade Forex? I don't often trade currency pairs. Currency pairs are not in my wheelhouse, but I gain access to the foreign exchange market through the use of futures, right? Now, who's using futures as an asset class for Forex? Well, a lot of institutions or companies that are hedging their risk against foreign currency without having to hold the physical cash, right? And there's reasons for doing that. If I don't have to hold the physical cash in my portfolio, then I still have an advantage over somebody who's tying up the cash in their portfolio. And so one of the things that's great about using those is that I still get all of the benefits of trading the currencies, right? I still get that. I still get those long running trends. I still get the ability to have my exposure to multiple countries and all of the other things. What I don't have to do though is worry so much about all of the different exotics and all the different pairs. See, because when you've got all the different exotics and all the different pairs, then it becomes a little bit more difficult. Then it winds up that you're tied to really knowing about each country. When I trade these, all I've got to do is use my 6 or so futures markets, right? So when I'm looking at currency futures, the ones that I tend to look at, I still look at the euro, but instead of trading the EUR USD, I can trade the 6E. Now it's the 6E on my platform. Some of you, the platform, it may be the EC. It's a little bit different, right? Instead of trading the GBP USD, I can trade the 6B, or for some of you, it might be the BP, and so on and so forth. So I still get access to currency markets. Now, one of the things that's interesting is think about, money doesn't disappear. It just flows. And sometimes it'll go from the stock market and it'll flow out of the stock market and into gold. And sometimes it'll flow out of the gold market and into cash. And sometimes it'll flow out of cash and go right into bonds, right? And sometimes it goes from bonds and right into stock. And it doesn't always go in this particular order. But the point is, money doesn't disappear. It just changes locations. Well, we see that a lot. That's one of the reasons why it's good to have multiple asset class exposure. Because since we have multiple asset class exposure, those of you that watch regularly, one of the things that we do, my main screen in the morning, if you look at my main screen every day is always starts with equities up in the upper left. Let me get my screen here so I can draw. So on my main screen, this is the S&P 500 up in the upper left. This is the NASDAQ. This is oil. And this is gold. I would venture to say that 70 to 80% of the levels that I find come from these four markets. I'd say most of the levels that I find come from those markets. And that's why I look at those markets most frequently. Those markets are the ones that give me most of my opportunities. If I go back and look at all of the different trades that we've set up, as far as you know, our live trade updates and all that kind of stuff, what I'll probably find is that most of my trade feed updates include the NASDAQ and the S&P. Those are the ones that I typically spend the most time on, right? If I pull up, like, here's our trade feed, starting with today's CL, NQ. Here's the euro, CL, NQ, GC, ES, ES, Russell, NQ, crude oil, crude NASDAQ, crude oil, S&P. You don't see copper very often, right? NASDAQ. Oh, as I said that, here's copper, S&P, NASDAQ, right? So these, if you go back and look, most of the trade setups are coming out of those markets. So intimately get to know those markets, because those are the ones that are going to be better. Okay. All right. Next. Now, one of the things that people like is that they can have a more favorable tax treatment. And not everybody's aware of this. Yeah, HG and Harrison. That's exactly it. Not everybody's aware of the tax treatments that can be applied to futures. But it's an interesting concept. And let me explain why. So let's say you're trading. Let's just do a little bit of simple math, right? I'm just going to make it reduce it to the ridiculous. Let's say you're trading the SPY or you're trading the ES. And in both of them, you make $100,000 as a short-term trader. Right now, how are short-term trades taxed? How are short-term trades taxed? Ordinary income. Very good. Short-term trades are taxed at ordinary income. So when you're taxed at ordinary income, let's say that just to keep the math simple, let's say that you're in the 40% tax bracket, right? So yeah, just to keep the math easy, $100,000 minus 40%, you're going to keep how much? $60,000, right? Now, the ES is taxed differently. There's a split. $60,000 is taxed differently than the other $40,000. There's a 60-40 split on the proceeds. The 40% is taxed at the ordinary income rate. Okay? So what's 40% of 40? I'll do the math. 16, right? So 40 minus 16 would be $24,000. Now, the $60,000 is taxed at the long-term capital gains rate. Okay, what is our current long-term capital gains rate? Right, depending on your income, right? 15%. So what's 15% of 60? It's 9, right? So 60 minus 9 is 51. Well, that means that of my in the futures position, you keep more than you do in the option in the ETF. Now, certainly tax rules are going to be individual for the person that you are. Consult your professional tax attorney or accountant so that you can understand that. I'm in no way a tax expert or specialist. I'm just illustrating for this concept. But this is a difference of $15K. Well, that's 25% more of your own money that you keep. Right? It's just a much more favorable tax vehicle. Now, why is it given that favorable treatment? Because it's used as a hedge. Because it's used as a hedge tool, it's given that favorable treatment. So the 60/40 tax ramifications are a major benefit for short-term futures traders. Another thing, and somebody brought this up earlier, futures are optionable. So those of you that trade options, futures are optionable just like equities. Now, equities have 100 shares per contract. It's very standard. Futures options are going to be tied to the actual contract specifications of the underlying, right? So knowing the underlying is very important when looking at the options on futures. But that's a huge benefit, is that they're optionable. Now, primarily because I can then use it as a hedge. And I know that on a number of occasions, we have looked at futures positions on a Friday, held it over the weekend, and seen a gap. And every single Friday, I give the exact same, what's the word I want to use? Disclaimer, right? To every single Friday, I give the exact same disclaimer. If you're going to carry futures over the weekend, make sure that you have a hedge or a plan in place. They don't always gap. Matter of fact, they usually don't gap. But it's when you don't have a hedge that they do. And oftentimes, if they do gap down, you're going to get not only the benefit of the move down. Let's say you were long going into the weekend and it gapped down. Well, if you purchased a put to act as a hedge, the volatility on that put may also rise, which now gives you an additional little kicker, and you can get out. All right. Now, last on this advantages of futures list are Sunday night setups. So I love trading futures on Sunday nights. Sunday night setups are awesome. I took a little screenshot of some of our live trading room archives. We archive all of our live trade rooms. But when you trade on Sunday night, what does it give you? Right? Think about Sunday night trading. What does it give you over everybody else? What does it give you over everybody else? That's not. You got a head start. It's exactly right, John. I got a head start as to what the market's going to do. And it allows me to get out in front of what everybody else is doing. So the Sunday night, I love our Sunday night trade rooms. I think they're awesome. And my favorite thing to do is to look at Sunday night. And I'm sure there's some of you in this room that would have had a better week if you just traded Sunday night and just shut the whole thing off the rest of the week, right? I love Sunday night sessions because it allows me to get in and take advantage of some of those big moves. Those are the times that we really, really, really set ourselves up for success, are those Sunday night sessions. So just something worth considering. So let's look at a couple of actually, I think John had a question about futures that I didn't get to. Higher up. Okay, so rollover and different contracts, I think, is what you were asking about. So there are situations of futures that are called rollover dates, right? And it's when does the futures contract roll over from one month into the next. So, for example, right now in crude oil, the contract we're looking at is the September contract. That will soon roll over into the next available month. And as they roll over, you're going to see an adjustment to price. Now, if you stay in the position, you're going to automatically see your P&L change at that adjustment. my recommendation is to close it before the automatic rollover. Because John, I know you asked that a bit different. So I think it's a better idea to close it before the automatic rollover occurs so that you don't suffer any of that gap. It's a very small transaction cost to get back in or get back out, but it's something that will save you really in the long run. And the idea behind doing that is I want to be able to take advantage of it. But for example, when I'm looking at my different contracts, just kind of heading back to the let me see if I can't, where did it go on me? Oops, there it is. It's hiding over there. Let me go back to the CME's website. So when I go to the CME group, I can very quickly see under, and I always go to the CME because it's, I mean, you're kind of going right to the source, right? But I can very clearly see if I go to crude oil, it's got all the contract specifications, all those different pieces that we talked about earlier. So I have to go here to get there. But what it'll also show me is the calendar. And I want to show you the calendar of crude oil, which has all of the different available months, right? So when I go to crude oil and I look at this calendar, this shows me all of the futures for crude oil. I've got September, October, November, December. Crude oil is a monthly futures contract, right? Now it tells me the settlement date of that contract, and really when that contract, is gonna shift over, right? So when I look at, say, the CLZ contract, now that's been traded for quite a while. It started trading in 2010. So this contract has been around a really long time, but there's going to be a price shift and a difference in price between those. So when I switch from the CLU to the CLV, when there's the automatic rollover from the CLU to the CLV, let's look and see what that difference is. So the CLU 19 is trading at 55.06. The CLV 19 is trading at, okay, we're also at 55.06 on that one. How about the Z? 54.50, right? So those front two are basically identical, but if I go off to the Z, then I'm at 54.50. Well, if there's a rollover, I'm going to have to pay that difference, depending on the where I am. Okay? So hopefully that makes sense, because I know that was something you'd asked about. So my my recommendation is close it before the rollover occurs. Okay. So let's look at the S&P today. And we want to look a little bit of some opportunities or what's happening overnight. So in an overnight session, we saw this happen in the S&P today. Huge move down. Unfortunately, never got a chance to get back in. Breakout trade was the way to go below this level. Never really got a chance to get back in. Never got a chance to re-engage. So looking at it on a 4-hour chart, our 4-hour upward trend, we had just put in a new higher swing low and kind of had started. But this move up was a speed candle. And what do we say about all speed candles, right? Speed candles tend to get retraced, and the retracement of that speed candle caused price. Price didn't just retrace to it; it retraced right through it and smoked right down. I think that our next real strong stopping point isn't until down in here. Okay, now this was a news-driven announcement. This was a news-driven trade. This was a most of this has been news-driven, very highly centered around tariffs. However, one of the good things about having the ability to trade futures is if we come into one of these levels in the overnights, you can set yourself up for some sort of a trade. Now, when I'm looking at this, I'm going to look at the time of the day that the quality levels were set up and structured. And as I see this, we now have another big speed candle down, and there's probably going to be some sort of a rally back up. Now, how high does that rally go? I'm not so sure yet. And when I look at this hourly level, I'm going to wrap my lines around the middle of this right in here, where we stalled for just a brief period this morning. So just this morning, we stalled for the briefest of times. And that's really what I'm looking at right now. Now, partially because that's a 50% retracement of this gigantic move down. Those 50% retracements are tend to be pretty strong retracement areas. May not come back up to there. We may roll over right from there. I will tell you, I'm not going to chase it. And so that's important to remember with futures, but I trade it just like I trade everything else. Okay. Now, one of the newest things about futures is the ability to trade micros. And the micros allow me to trade the S&P, still controlling it, but I trade it with a lot less risk, a lot less exposure, okay? So one of the things that we wanted to actually provide you guys with is a little cheat sheet, if you will, of the different futures, symbols, and contract specifications. So here we have the equity indexes, the micro equity indices, the commodities that we trade, the bonds. Now, for bonds, we only do the 10-year and the 30-year. Some people do a lot more than that. We just do the 10 and the 30-year. And then currencies, euro, yen, Canadian, British pound, and the Australian dollar. So all of those are in place. So we wanted to build this out, and I'm gonna put this in the chat box for all of you so that you can have a copy of this future symbols and contract specifics, and you can print that out and put it next to your workstation, just so you got a quick reference of each one of these that you might want to be looking at and you might want to be trading. Now, every broker is going to have a different naming convention for their symbols, but just make sure that you're aware of kind of what that is for each one. If you're watching this on recording and you want to get a copy of this, send us an email, support@tradersarmy.com, and we will gladly send you this. Okay, so I'm going to push this into the chat box so that you guys and gals all have it, and hopefully that will be a resource that you can use. So it is now. Oops, I just sent it to Mike. You're welcome, Mike. There you go. So now it's a resource. So you all should be able to download it right from the chat box so that you can have a copy of that particular one. All right. So I want to open up the floor for any questions you might have. John, I hope that Mike answered whatever questions you might have. If you've got more questions, I actually saw you sent an email earlier today. We can hop on the phone if you want to talk through it. I will definitely talk through any of it that you want to talk through, because I'm just much better over the phone than I am via email. So let's get together if you want to chat over the phone. What questions do you all have for me this evening? Maka, great question. How do you calculate risk for stop placement? Awesome question. I'm glad you asked that. So it's important to know the value of the different futures contracts that you're trading. So for this example, let's say that you're trading, gold, okay? And gold is $10 per tick. Now, let me ask you this, Maka. Who's in charge of how much money you're willing to lose? You. Matter of fact, that's the only thing you can control, is how much money you're willing to lose. So when I trade futures, what's important to do is to have a calculation, okay? So when we're looking at futures, we have to determine, or really anything, willing loss can't spell loss, divided by position risk equals position size. This is the equation. Willing loss divided by position risk equals position size. Now, Why is that important? Well, let's go back to gold. So gold is $10 per tick, right? So let's say I'm looking at gold and I see this level right here. I see this little bitty level right there, but I know that my stop has to go down here because it's got to be below the pivot. The chart determines where my stop goes, right? So in this case, my entry is 1512. My stop is 1507. Let's call my entry 1513 and a stop at 1507. Now, if it's $100 per point and I've got an entry at 1513 and a stop at 1507, what's my risk on one contract? Well, it's 1513 minus 1507 is 6. So it's 6 times 100, which is 600. Okay. So my position risk in this trade would be 600. So now what do? Well, I go to my calculation. And if my willing loss is 800 and my position risk is 600, that means I can trade one contract. What if my willing loss is 400 and the position risk is 600? How many do I trade? Exactly. None. Right? Well, and that's where micros get very, very valuable. That's where micros get valuable, is because I can trade a micro contract in a lot of different futures. I can trade micros. The gold micro, is there still a gold micro? I know that at one point it was QM. No, not QM. Is there still the mini gold, the smaller version of the gold? I'll have to go back and look. YG, that's what it is. Okay. That was the mini gold, was YG. And I don't think that they chart it anymore on this particular platform. Yeah, it used to be there, but I think it's gone. But for example, like QM is my mini of the crude. So it's 1/10 the size of a normal crude contract. And that's why we have the micro index futures. Micro ES, micro NASDAQ, micro Dow, and micro Russell. That gives me the ability to get in. Okay. Let's see. Question was, is there a way to see somewhere in the thought? Mike answered that. William, tell me about your purple versus green lines. Also, are the dashed green lines defining your higher time frame curve? No. Not at all. So one of the things I would say is I'm gonna show you where you can watch. It'll take a little bit more time than what I have, but I will introduce it to you. So if you go under free trading videos on the website, I've got a video on what all the different lines mean. It is, where is it down here? Drawing the lines on the charts. That's what it is. It's this one here. So, but very quickly, green lines are 60-minute charts. Purple lines are 15-minute charts. Dashed lines are confirmation entries. Blue lines are breakouts. So they all have a different meaning, and I know kind of what they all do and what they all mean based on the trade style that I'm doing. So it's really, for me, more about time frame. You mentioned curve. Curve is not something that I really, in the sense that a lot of traders have used curve, is not what I do. I've got a slightly different method for that. I use trend much more. Fahim says, how do you do homework to trade the next day? I don't. Maka, give me 1 second. I'll get back to that. Fahim, how do you do homework to trade the next day? I don't. I get up every day as if it's a brand new day, Fahim. So when I get up to look at the daily market commentary, that is my morning routine. The first thing I do when I wake up, as far as getting myself going, is I come in, sit down, and I open up the charts and I press record. So when you watch the daily market commentary, you're watching my morning routine. I don't do anything the night before. I don't set up the night before unless I'm doing a webinar. So the only way you can do you can see your loss, your stop value is to use what's called the Analyze tab, which is, we use it for options primarily, but you certainly can still use that for futures as a way to see what your loss would be in that position. That's a way that you can look at it. Let's see. Try to make sure I get all the questions. 2 a.m. is a good time to look at setups. Is there times of the night just to not trade at all? If you have a position open, hang with it, but be sure to have generous stops. Seem to get crushed with stops in gold. Yes. I do not trade typically this time of night. Not at all. If I'm in a position, I'll move a stop and protect it, lock it in. Going into the overnight, sometimes I'll just close it out. I do not trade this time of the night at all. 2 a.m. is a great time to look for levels and an awesome time to get into trades. But frankly, I don't get into many at that time because I don't really like the whole set it and forget it style. I just don't think that you can truly set it and forget it all the time. I think that I don't think you can truly always set it and forget it. I think that you have to look at the arrival. And if you don't look at the arrival, then you'll be able to, if you look at the arrival, you'll be able to make a better decision. And if you don't see the arrival, you're not going to make a great decision, which is why I don't trade at 2 a.m. all the time. I'm in bed. I'm sleeping. That's more important. So, yeah, alerts get handy. So what time do I post the DMC? Peggy, anytime between 5:30 and 7, typically. I try to have it out every day by 7 Central. But usually it gets up around 6. So somewhere in that time of the day is when I'm in there. Somewhere in there is the sweet spot. Like this morning I was up super early and I had it recorded by 4 something and it was posted by 5:15. So every time is a bit different. So yeah, Peggy, I always do the daily market commentary recorded. I've done a couple of trade the open sessions, and I might do a few of those today. So yeah, Frank, it was done a little early today. I got in a little bit early, and caught some of it pretty early. But it is I sometimes do them pretty early in the morning because I'm kind of an early riser. It really just depends on when I get my butt out of bed. So, well, thank you, Mr. Denton. All right. Well, I'm going to turn this thing off. Real quick message for those of you that are subscribers. Tomorrow night, we're doing an options session. So I know a number of you had requested a slower option session. So we're going to do an options session that is a lot more basic, a lot slower, just purely educational for you. So you can so that you can feel like you grasp it. For those of you that are not subscribers, I'd love to have you join us. We have we got a promo code Trader60 to get 60% off of your first month's membership. So come give it a try. Hopefully you like it and you don't hate me for my jokes. But it'll still be hopefully something that you are interested in. So those of you that are not subscribers, please feel free to join us. Tomorrow morning, yes, John, tomorrow morning, 7 a.m. is our live trade room. And I'm doing the 7 p.m. session for those of you that want the options sessions that we're putting on the calendar. So hopefully you guys will really, really appreciate those. But that's all I have for tonight. Thank you guys for joining me this evening. If you have any questions, shoot us an email. I will see you guys in the live room tomorrow morning at 7 a.m. Later.